Where are you on all of this? Have we flipped into a bear market, or are we still holding bull market support? How are you looking at the markets right now?
Yeah, look, I feel a little bit personally attacked, by the way, coming in here. You're talking about charts or astrology for men. You got to know your audience here. No, I'm kidding. I'm kidding. But in all seriousness, this market, in my opinion, has still been on fire. I know if we're thinking specifically about what's taking place in Bitcoin, what's taking place in crypto, largest liquidation events in crypto history, at least on a market cap basis, that was not a lot of fun, or in some ways it kind of was. But I mean, let's really kind of contextualize what's actually taking place here. Since we recorded that podcast the last time that I was on in earlier mid-September, we've seen great things continue to take place. First of all, not only did Bitcoin go from 108,000 to 126,000, but we've seen continuous new all-time highs even in the equity market. So if we start first and foremost just looking at the NASDAQ 100 here, by the way, the NASDAQ 100 last week had its highest weekly close of all time. And today it's on track for its highest daily close ever. That's in an environment, by the way, where the Russell 2000 is making new all-time highs, microcaps IWC is making new all-time highs. And then we could break it down a step further. If we look at industrial stocks, which have the highest correlation out of any sector in the market versus the S&P 500, this looks fantastic to me. Of course, it's kind of been flagging up here for the past few months, but no harm, no foul. This looks great. If we look at semiconductors, which have without question, been the leader during this bull market, these are making new all-time highs today, up 2% when I took this screenshot less than an hour ago. And then let's look at some of these intermarket relationships. We have growth relative to value stocks making new all-time highs. And we also have high beta relative to low volatility making new all-time highs. So as far as I'm concerned, it's very important for investors to remember and recognize uptrends are just the sustained production of higher highs and higher lows. We need to give the market the freedom and the opportunity to produce higher lows. And so, of course, in my opinion, that's what's taking place with Bitcoin right now. But as we look at the equity markets, they're in process, literally as we speak, of producing higher highs. So as far as I'm concerned, we still have very clear-cut uptrend confirmation across the board.
Great. So I think, you just went through a lot of charts really quickly there without drilling down on all of them. Maybe just unpack this one here for us. What does high beta versus low volatility mean? And what is that telling investors if that chart is making new all-time highs?
Yeah, this is one of my favorite charts because as we think about high beta stocks, what does that mean? It means high beta relative to the S&P 500. So if the S&P 500 is up 1%, high beta stocks are going to be up maybe 2%. If the S&P 500 is down 2%, high beta stocks might be down 3%, right? So they're going to have these larger moves relative to the rest of the market. Whereas low volatility is exactly what it sounds like. These are going to be much more defensive in nature, much more of like consumer staples stocks, very, much less cyclical. And so when we're looking at this chart, high beta relative to low volatility, when this chart is going up and to the right or producing higher highs and higher lows, that's telling us that we are in a market environment with very strong risk appetite. Risk on is outperforming risk off. That doesn't tend to happen during downtrends. That doesn't tend to happen during bear markets. On the contrary, it exclusively happens during uptrends and bull markets. So as we're looking to kind of basically confirm or deny the weight of the evidence that's taking place at the index level for the S&P, for the NASDAQ, for the Dow, for the Russell, these kinds of intermarket relationships are really important to kind of provide some of that additional context.
Gotcha. That's really helpful insight there. And this is one of the reasons why I love having you on. You don't just do astrology on charts. You find new ways to look at the market through this analysis. This is really helpful. So this is telling us that allocators are seeking risk, not defensive allocations in the equities market right now. Really helpful insight. I wanted to ask you about another thing. You put out an article on your Substack this weekend focusing on the relative performance of small cap growth versus small cap value. And you called this the most important chart for the stock market right now. Why is this chart so important? And what is the message that this is sending to investors right now?
So this is a super, super underrated chart. Most people probably don't even know these ETFs exist, right? So this is the Russell 2000 Growth ETF, IWO, relative to the Russell 2000 Value ETF, IWN. First of all, let me just be very clear. Both of those ETFs literally right now are in the process of making all-time highs. So both of those funds are performing quite well, at least from a structural perspective. But when we look at them on a relative basis, it's providing very similar analysis to what we were doing earlier with high beta relative to low volatility. When this chart is producing higher highs and higher lows, as it has been since the middle of 2022, that's generally a confirmation of the uptrend that we're seeing at the index level for the S&P 500, for the NASDAQ, so on and so forth. But I also think there's something really important here from a macroeconomic perspective, right? I'm an economist by way of training, if you will. That's what I have my bachelor's degree in. But, charts are king, price is truth. And so for me, this is what's really important, because let's think about this. Small cap stocks, and in particular, small cap growth stocks, are going to be extremely cyclical by very nature, right? So when we're looking at the small cap universe and we're saying, hey, how are those small cap growth stocks performing relative to the value universe? When this chart is going up and to the right, that's basically additional confirmation that we're in a relatively strong or robust macroeconomic backdrop, because investors would not be bidding small cap growth stocks relative to small cap value if they were pessimistic about the future. Look at when this chart peaked, by the way. It was the end of 2021 going into 2022, and then it had this massive drawdown and bear market, right? Excuse me, I misspoke. The end of 2020 going into 2021. By the way, early 2021 is when like the ARK universe peaked. That's when a lot of the speculation, the SPACs really peaked out, right? So this chart is really, really important. And so as we're looking at this right now, making higher highs and higher lows, trading at the highest levels since Q4 of 2021, this is not insignificant. And by the way, let's also contextualize this with this chart here. In the lower pane, I've just added on TIP, which is a Treasury Inflation Protected Securities ETF. This is so important because if we think about economics from a Keynesian perspective, where growth and inflation are positively correlated, when we look at this ratio here of IWO relative to IWN in the top, and then Treasury Inflation Protected Securities in the bottom, we're getting a lot of there's a lot of consistency between these two charts. They look almost identical. And that's because the market is pricing in higher inflation as well, right? So not only are we seeing higher growth expectations, but those higher growth expectations are coming at the cost, if you will, of higher prices and higher inflation. So not only is this IWO versus IWN chart so significant for markets, it's also extremely significant from a macroeconomic perspective as well.
Okay, very helpful. So what you're saying is that the long-term trend that we've been in for several years is still holding, and that inflation expectations and continued growth is still what the market is forecasting. Is there a indicator that you are looking for, a single indicator or a confluence of indicators that you're looking for to be able to say when the market might have topped and flipped bearish? Because I think a lot of people are trying to figure out when we've hit that point. And what would you have to see to change your mind to say that this bull run's over, we flip bearish? How are you thinking about that question?
Perfect. So for me, it really comes down here to credit spreads. And so this is just the US corporate index option adjusted spread. What we're looking at here is corporate bond yields relative to treasury yields, basically on the same duration. And so one of the reasons I think for me why I've been able to stay so calm during this pullback, I was on another show about 2 or 3 weeks ago before the whole China tariff stuff came back into the picture again. And I referenced the next chart that I'm about to show you, but let me just preface this very quickly, is what I'm about to do is just invert this chart of credit spreads, and then I'm going to overlay the S&P 500 in the bottom pane. And that's what we're looking at right here. And so historically, what we tend to see is that very bad things happen in the market when there's a divergence taking place between corporate spreads and the S&P 500. So if we look down here, when the S&P 500 was making higher highs and corporate spreads were diverging, same thing was taking place at the end of 2021. Same thing was taking place in Q1 of this year. Bad things tend to happen, right? We obviously experienced a very significant drawdown at the beginning of this year. 2022 was a terrible year, and then we obviously had COVID. So as far as I'm concerned, this chart has basically forecasted the 3 biggest drawdowns that we've endured over the last 5 years, and I think that's really significant. The thing that gave me a lot of confidence in this market environment is the fact that we did not have that divergence in this current environment. Right. So again, it goes back to kind of what I was saying earlier, which is that uptrends, which we're in one right now, have pullbacks. Those are completely normal. There's a kind of this funny phrase that I've been repeating, which is that if you don't love a bull market at the opportunity to produce a higher low, you don't deserve it when it's producing a higher high. Right. And I think that's really, it's such a cliche statement, right? But it is really important. So we have to give this market the opportunity to produce a higher low so that we can enjoy the higher highs. And in fact, we should actually be allocating into that potential production of a higher low, at least as far as I'm concerned, because we're not seeing these bearish divergences taking place.
I don't think that catchphrase is going to catch on, but I like it a lot. So yeah, I appreciate the perspective on that. So you brought up the S&P 500. A lot of analysts have been calling for the S&P at 7,000 by the end of this year, by early next year. Do you see that happening? What is your forecast for the path of the S&P from here? Just directionally higher, or is there a specific target that you're looking for? What are your thoughts on that?
So I don't have a target for the S&P 500. I think one of the things that I've learned as an investor over the last 12 years is trying to call a top, especially during a bull market, is a fool's errand, right? And so all I know for a fact is that we're in a bull market, we're in an uptrend. So why try to cut the party short? You know what I mean? And so if we're in this uptrend, and we are, then let's just do whatever we can as investors who are focused on making money to align with that uptrend as much as we possibly can, instead of trying to forecast when it's going to peak out. And so in a market environment where forward 12-month earnings for the S&P 500 continue to make new all-time highs, we have interest rates modestly coming back down. This is an environment where we still want to be net long. We might want to, cut the weeds and water the flowers in terms of portfolio management here. But as far as I'm concerned, this is still, for me, an environment where I want to be adding to core portfolio holdings. This is where I want to continue to be net long, so on and so forth. And that's basically what I continue to do, at least.
Gotcha. Yeah, very helpful perspective. I like the metaphor of leaving the party early. When I was working at BlackRock, I had a rule: I would always leave any corporate parties at 10 p.m. But that's not what you want to do in a bull run. So that's really helpful. I want to talk a little bit about some of the flash crash and the trade war, Trump's tweets. You talked about crypto. But let's start with the S&P 500. A lot of people are blaming the pullback we saw on Trump's tweet. We saw the S&P 500 dip pretty hard following that. And for those who don't know, it was a tweet about escalating the trade war with China, and putting 100% additional tariffs on them. And that kind of kicked off a lot of things. But the dip in the S&P wiped out, I think, $1.6 trillion of market cap before it started to bounce. Do you think that this has shaken investor confidence? Do you think there are lingering concerns from this? Or has the market mostly digested this and moved on? Like, where are we right now in that?
I hope it's shaken investor confidence, because I've been buying, right? So I need somebody to buy those shares back for me in 3 to 6 months or a year, right? So I think, of course, it's shaken investor confidence, because when you're dealing with something as unpredictable as what is Trump going to tweet today, we can't predict that, right? And so it's not my job to try to forecast that. I'm certainly not a political strategist, and even if I was, I'd probably be a terrible investor. And so as far as I'm concerned, I just want to be focused on price. I want to be focused on these intermarket relationships. I want to be focused on statistical indicators, because if you ask 100 people, what is the risk of Trump tweeting anything that's going to be a risk to the market, you're going to get 100 different answers and 100 different magnitudes of those risks and timing, right? And so I have no edge there. And so if those things do come to fruition, then I can just rely on the technical analysis. And so for me, when I'm looking at a pure retest of the 21-day EMA for the S&P 500, when I'm seeing weakness under the hood in terms of the S&P 500, looking at RSP, which is the equal weight version of the index, for me is an environment where I'm saying, hey, some of these stocks that I've liked that maybe I haven't owned, I want to start building a position in, right? So I've been able to add to some semiconductors. I've been able to add to some of these cybersecurity stocks, which I already own a lot of anyways. But I'm saying, hey, some of these are down, 20%. It would be almost foolish of me not to be taking advantage of some of this volatility.
Gotcha. I think that's a helpful way to think about this. I would like to hear some of your thoughts on this, though, because no one, like you said, can forecast Trump's tweets, but he does move the markets a lot when he does that. How do you think about this new idiosyncratic risk as an investor? Is it, like you said, this is just like you ignore it completely? Do you try to take advantage of it? Do you just wait till the noise blows over? Because I think a lot of people now are starting to be like, okay, this might be something that happens every couple of months where he tweets and several $1 trillion of capital move. How do you think about that? Is that something investors need to pay attention to or just completely ignore? Like, what are your thoughts on that?
So let's suppose you're right, and he does do things like this every few months. Like, we're 6 months down the line, 3 months down the line, more things are happening like this. This is where, the power of technical analysis, having a plan, is going to be really impactful, because again, we can't predict when those things are going to happen, but we know exactly what bull markets look like. We know exactly how they behave. We know what uptrends do. And so if we just quantify that and reverse engineer it and say, hey, during uptrends, when are statistically favorable times to be adding the risk assets? Then regardless of what the headline risks are, we should be probably allocating some money into that environment. I'm not saying go all in. And this is also a super healthy reminder here to not be touching leverage, to not be, for me personally, I don't trade any options, right? Because, I was able to sit through some of that volatility, 2 Fridays ago, and I was actually having a hell of a lot of fun. I've been looking at the market for the past several months. I'm saying, look, I've been bullish. I've been optimistic because we've been in a bull market. By the very definition of that recognition, I'm expecting to make new all-time highs. So as we continue to make new all-time highs, I'm bored as hell. Nothing new is taking place. So it's actually the contrary. When we see some of that volatility come into the market, when we see things go haywire and we see a lot of investors run around like chickens with their head cut off, that's where I start to perk up. That's where I sit up in my chair. I say, hey, now I actually have a chance to go out and make some money in this market and take advantage of everyone else's laziness and fear and use that to my advantage.
Want insights on what's really moving markets and how we're trading each event? Subscribe to our channel, then join the Milk Road Macro and Macro Pro newsletters. This show is for educational purposes only. Nothing we say is financial advice. Investing is risky. Never invest more than you can afford to lose.